Welcome to Demystifying Return on Equity, the ultimate guide to measuring a company's profit power. Return on equity, or ROE, is the ultimate financial performance ratio. It measures how effectively a company uses your investment to generate net income. Think of ROE using the simple lemonade stand example. If you invest $100 and the business profits $20, the ROE is 20%. It asks how much profit the company generated from the money shareholders invested. The ROE "profit machine" has two main ingredients. Ingredient 1 is net income, the money left over after all bills, taxes, interest, and dividends are paid. Ingredient 2 is shareholders' equity, which represents the company's net assets, what it owns minus what it owes. The core formula for ROE is net income divided by average shareholders' equity. We use the average of shareholders' equity because equity is a snapshot, while net income is earned over a full year, ensuring a more accurate measurement of efficiency. Beware of the one-size-fits-all number. A good ROE depends on the industry. Asset-heavy industries, like utilities, often have a normal ROE of 10% or less. Asset-light firms, like technology, frequently see 18% or more. A broad rule of thumb is that an ROE below 10% is generally considered weak. The golden rule is to look for an ROE equal to or just above the average for the company's peer group. Never compare companies across vastly different sectors. For instance, if TechCo's ROE is 18% and the industry average is 15%, TechCo is outperforming its peers. ROE helps predict future growth through the sustainable growth rate, which is ROE multiplied by the retention ratio. This ratio is the profit percentage a company keeps to reinvest. If a stock grows wildly faster than its SGR, it's likely borrowing heavily. While a strong ROE is positive, an extremely high ROE can be a red flag. Because ROE is a ratio of net income to equity, an extreme spike might not mean massive profits, but rather that the equity account has artificially shrunk. This video will now look at two common traps. Trap 1 is the debt illusion. If a company borrows aggressively, debt increases and forces equity down, as equity equals assets minus debt. Large-scale borrowing for stock buybacks shrinks the equity base, inflating ROE and increasing the risk of popping. Trap 2 is inconsistent profits. If a company loses money for years, its equity shrinks. A single profitable year, divided by that depleted equity, results in a misleadingly high ROE. The rule of thumb: never trust a negative ROE, as it implies a net loss or negative equity. To expand the view beyond shareholder money, look at return on invested capital, or ROIC. ROIC evaluates how well management uses all available capital, including debt, giving a broader measure of efficiency than ROE alone. The pro move is DuPont analysis, created in the 1920s. It breaks down the single ROE number into core components. Instead of just knowing ROE went up, DuPont analysis reveals why. Was it driven by better profit margins, faster sales, or excessive debt? The three gears of the DuPont formula are net profit margin, which is operating efficiency, asset turnover, or asset use efficiency, and equity multiplier, which measures financial leverage or how heavily the company relies on debt. Here is the smart investor's ROE checklist. 1. Calculate with averages. 2. Find the peers for comparison. 3. Hunt for debt if the ROE is unusually high. 4. Check the growth speed using the sustainable growth rate. Return on equity is the ultimate gauge of profitability and efficiency, but no single number provides a full picture. Use ROE as your primary diagnostic tool, but always utilize a combination of metrics like margins, cash flow, and debt before you invest.